Hello, welcome back to my channel. Thank you for watching my videos. In today's video, we're going to look at the qualitative characteristics of cost and management accounting. So if you've done accounting before, I believe most people watching this video or everybody watching this video is doing accounting and you've done accounting 1. So these are the very same qualitative qualitative characteristics of financial statements. So number 1, we have verifiability. This refers to the ability of accountants to ensure that information is what it purports to be, or it is what it purports to represent. So this is going to be done by knowledgeable and independent observers, or we could say auditors. For example, auditors are going to make sure that the accounting information relays exactly what it is supposed to relay. It does exactly what it is supposed to do. For example, if you're having two accountants looking at the same information like inventory valuation, they are supposed to come to similar conclusions because that is what the information is trying to give them, not everybody being able to derive their own conclusion from it. It's information is supposed to give the same meaning that it is supposed to give. Then we have objectivity. This is also one of the characteristics that are useful in planning and making decisions. Accountants' reliance on verifiable evidence such as delivery notes, Accountants' reliance on verifiable information such as delivery notes, invoice orders, physical counts in the measurement of financial results. Okay, I'll go through that again. Objectivity. This is also one of the characteristics that are useful in planning and making decisions. Accountants' reliance on verifiable evidence such as delivery notes. So these are the different financial statements that can be used in decision making or in accounting to provide accounting information, the delivery notes, the invoice orders, and so on, and they can help in the measurement of financial results. Objectivity makes it possible to compare financial statements of different firms with an assurance of reliability and uniformity. So, for instance, a management accountant should not alter or change when provided the information to top level managers so that the manager can make accurate decisions without being influenced. The other is comparability. A management accountant should prepare the accounting information in a consistent way for every year. That means if you're using a certain standard to prepare this information, you're using a certain method, a certain way to prepare information of a given year, it should be the same and consistent every year so that it is much easier to make comparisons with past information or related entities. If you're going to compare information of two entities, you should first make sure that both those entities are using the same accounting methods, the same accounting principles, they're following the same guidelines so that you can easily compare this information. The other point is reliability. The reliability of an item is the probability that the item will perform a specified function under the specified operational and environmental conditions at and throughout a specified time. The best way to specify the reliability of an item depends on how the item is expected to function. So the item accounting information should be reliable. Then we have understandability. It is assumed that users need to have a reasonable knowledge of business and economic activities and accounting and a willingness to know more within reasonable diligence. A management accountant should prepare the accounting information or summarize the report and analyze an analysis that easily is understood by the decision maker. So it should be understandable to a layman or the decision maker that is actually going to use this information. And then we have relevance. This is also one of the important parts in planning, control, and decision making. To be useful, information must be relevant to the decision-making needs of the users. To be useful, information must be relevant to the decision-making needs of the user. So it should be, in other words, when somebody talks about relevance, it should be of importance to this user. So in my next video, we're going to come back with the benefits of cost accounting. Be sure to subscribe so that you don't miss out on the video. Hit the notification bell and you'll get notified every time the video is up.